Hi, Jamie.
Hi, Justin.
Okay, Justin Botillier, CEO of Calyx CPA, here with my business partner, Jamie Jorgenstone, tax extraordinaire. We just got done with a protective claimant amendment Q&A webinar where we had about 9 or 10 people, most of which were our current clients. A few were people who are interested in what we have to talk about. And it wasn't recorded. We wanted to protect the privacy of those people, but we wanted something that we could refer to people who might be interested, who may be missing those meetings, and kind of go over the questions that they had again, so that, that hopefully this video could be informational. So I'll do a little quick introduction, then we can let's hash out some of those questions and answer them. So the reason for this webinar and this video is that in the wake of Trulieve receiving refunds of $113 million, they kind of pretty much opened a can of worms in terms of amending tax returns for refunds for the cannabis industry and the applicability of the Controlled Substances Acts on state programs, and whether or not state programs should essentially be, or cannabis businesses in legal states should be subject to 280E. And whether or not we can amend for refunds versus just going forward once rescheduling happens. As you may know, the HHS and the FDA have recommended that the DEA reschedule from Schedule 1 to Schedule 3, making it still subject to CSA. Cannabis is still subject to CSA, but not, but 280E no longer applies to that. Now, that was one of the questions: is that retroactive, or is that just going forward? And our conclusion is it's just going forward, it's not going retroactive. However, there is sentiment amongst the industry, and especially the industry professionals, the tax firms and the legal firms that are representing some of these big companies, that that states with their own drug policies or their recreational programs, medical and recreational programs, should not be subject to federal enforcement, that it is unconstitutional. And there's several court cases and some precedents that are being reconsidered. And if they had been tried in the current cannabis climate, and the fact that we have a conservative Supreme Court justice, that it may have been, the outcome may have been different, and that there's a lot of sentiment that that state program, it's unconstitutional to subject state programs and cannabis businesses in states with state programs to the CSA, Controlled Substances Act, and therefore it should also not be subject to 280E, and therefore there is an argument to amend. But jump in, Jamie.
Okay. Yeah, just to chime in for a moment. So I just wanted to say one clarifying point, which was they're not, those previous decisions are not currently being reconsidered officially, but there has been a theory basically circulating that if the same, if the same case was tried today, the Supreme Court would reach a different conclusion, because the facts and circumstances and just like the general regulatory landscape has changed so significantly since 2005, when that first court case was tried. And just to lend a little more context to what you're saying, so 280E is written into the code. It specifically applies to businesses involved in trafficking controlled substances within the meaning of the Controlled Substances Act, and it's Schedule 1 or 2 controlled substances. And as I just said, specifically within the meaning of the Controlled Substances Act. And so the Controlled Substances Act is what allows the federal government to enforce drug policy across the United States. But the federal government, by design, is very limited in its power, and it's only allowed power that is explicitly granted to it via the Constitution, right? And so the CSA derives, or the federal government derives its ability to enforce the CSA from the Commerce Clause of the Constitution, which actually very specifically applies to interstate commerce, meaning between the states, not within a single state. And this court case back in 2005 that Justin mentioned was challenging how the CSA may apply to intrastate, so just a state legal program that does not cross state lines. And ultimately, the decision upheld that the CSA, the Commerce Clause basically does give the federal government the right to even enforce the CSA for intrastate activities, because of the fact that those intrastate activities have a greater effect on, interstate activities, right? So they said in order to effectively enforce the CSA, you have to be allowed to basically regulate at the state level too. Fast forward 20 years, right? And the federal government appears to not want to regulate those industries at all, right? They're more or less hands off. And this idea of uniform illegality across the states, which was kind of like a key takeaway from that original case in 2005, is nowhere to be found, right? As you mentioned earlier, Justin, is it more than 50% of the states now have a rec program?
I know that it's more, it's like 36 have a medical and or rec program.
Right.
And then I think we're at half now have at
least
a rec program.
Yeah. Including, a program, a state legal program, in DC, right? Like DC. And then there are some other, there's various other things that help support this idea that the federal government wants to keep its hands off. One of which is that the Rohrabacher-Farr Amendment, which is a budgetary amendment that says the Department of Justice, I think, can't allocate any funds to, this is medical specific programs, but still state legal medical programs. They're not allowed to allocate any funds to, enforcing any sort of, like enforcing the CSA or whatever you want to say on those state legal programs. And there's various other items as well, the Cole memos. So there's a completely different landscape now. And so the idea is there's this theory, as I mentioned, that if we were to retry that case, the Supreme Court would likely have a different interpretation of the Commerce Clause. And that's also supported by recent other cases that have come across the Supreme Court, where there's been a much more restrictive interpretation of the Constitution and specifically the Commerce Clause, but other clauses as well, where they're kind of, previous to this, there was like a history of a pretty broad interpretation of these various clauses within the Constitution in order to kind of expand the federal government's reach. And we're seeing that retracted lately. And so all of this kind of there are various pieces that support this new
Roe versus Wade being huge.
Right, that's a huge one where that's now a states' rights decision, right? It's not, the federal government doesn't get to say one thing for all of the states. So that's one. And there's various other cases lately that have like leaned in that same direction. So all of that supports kind of this new position that True Leave is sort of the trailblazer of.
Yeah. So some of the other questions, so there's way more to talk about there, which is interesting. But so what we're recommending and quietly recommending is that you potentially amend your returns for refunds. We've gotten some word that some cannabis companies that are amending for refund to recapture lost deductions due to 280E have been given refunds. And so why not our clients? Why not these small cannabis businesses? And small, I mean like 29 million and less, or I don't know, even anybody at this point. they're all getting going for it. And so let's talk about the details of what that looks like. Do you want to talk about that, Jamie?
Where do you want me to start?
Let's see. Let's talk about the statute of limitations.
Okay, yeah, that's a great place to start. So the statute of limitations allows a taxpayer 3 years from the date they filed a return to amend that return, basically. And so the idea is that, right now, assuming a timely filed tax return, whether with or without an extension, right, 2020 is the furthest back a taxpayer could go right now to amend. Anything prior to 2020, the statute of limitations is closed. 2020 possibly is still open for some taxpayers, assuming they did extend that tax return. If they timely filed either on or before, April 15th, if they're a corporate taxpayer, or March 15th, if they're like a pass-through, their statute of limitations is probably closed at this point for 2020, right? If they did extend, there's a chance we can still amend 2020, and then 21 and 22 are still open for another year or two. And so what's really important is that you can't go back any further, right? So to protect those deductions that you may be able to reclaim, some action needs to be taken, really kind of immediately for 2020. And that action can either be what's called a protective claim for refund, which is a more conservative approach, which basically is just this letter that we send the IRS that says, hey, there's some uncertainty, there's a contingency out there that affects my tax return. Until that contingency is resolved, I'd like to keep the statute of limitations open and preserve my ability to go back and amend that tax return in the future, even after, when the statute of limitations would have closed, did you not file that protective claim for refund. That protective claim has to be filed before the statute of limitations expires. So you've got, the clock is ticking on that as well. The other option is, depending on how you look at it, maybe more aggressive, right? But the idea is just go ahead right now and amend your tax return. The way that we would do that is we would, prepare an amended tax return and include along with it a pretty substantial disclosure that explains our position pretty thoroughly and says, exactly what we're doing. We're not applying 280E, and we're not doing it because of, X, Y, and Z. And we believe that we have a reasonable basis to file this amended return. Reasonable basis meaning like the minimum required level of assurance to take a tax position and basically avoid penalties on it being like some sort of negligent position or a fraudulent position even. So it's not saying we're sure this is going to work, but it's saying there's a reasonable basis that this is true, enough so that I can file this tax return and I'm taking the position and I'm telling you all about it, not trying to cover anything up, and see what happens, right? And as Justin mentioned, not only have we seen, right, Trulieve, who's been public about receiving some refunds with an argument that is, we don't know the exact details of their argument, but we do know that it is similar to this argument in some ways, right? This is probably the foundation of their argument.
There's been other companies that have also filed for refunds who have been a little bit more public about their approach, and it has to do with the constitutionality of the federal enforcement of the Controlled Substances Act on state programs.
Right, and so, and as Justin mentioned in the beginning of this little Q&A, that we have heard that that our colleagues have filed some amended returns just for kind of, the average Joe, not these big public companies, and have been seeing refunds come in. So we can't guarantee that an amended return will result in a refund. We can't guarantee it won't result in an audit or a dispute, but currently it's looking favorable, the environment. I will add, receiving a refund does not mean the IRS agrees with your position necessarily. So the IRS, just like the taxpayer has 3 years, a statute of limitations to amend a return. The IRS has that same statute of limitations to audit a return and make adjustments. And the IRS could process an amended return, issue a refund, and as long as that statute of limitations is still open, they still could go back and audit it eventually. So a negative result in that audit would mean you would be required to maybe repay those refunds, maybe repay them with interest and potentially penalties, depending on how that plays out. So there is certainly risk associated with the position, but as I said, the environment is looking pretty favorable right now.
Mm-hmm, mm-hmm. And like, so worst case scenario, so this isn't probably for the faint of heart, and it's for people who have their stuff together, you know, their records, their books and records that can endure a regular audit, because that's how the IRS historically has gotten people, is just simply from the fact that they didn't have good records, which gives them liberties to completely take advantage of them. But if you narrow down the issue to whether or not 280 applies to your business, then it's a different conversation. And for our clients, we have been using a 471C methodology, a fairly aggressive but defensible and position to get our clients' tax liabilities down to near levels that are similar to legal businesses. And so far, we have not had any problems with that. And we've even heard that the IRS is like avoiding taking the 471C approach to tax court. So for our clients, we would simply be picking up the remaining loss deductions. And I believe the worst case scenario would be that we would just have to fall back on the original way we prepared the return. So for people who have not been using us, or who have had other more conservative accountants or taking more conservative approaches, they ultimately may end up just being rejected and them saying like, no, we don't agree. But there is always the option to take it to the Court of Appeals and the tax courts. And from a tax, and then just as a aside, the way the tax court of appeals works is that you are negotiating with them, and they have the right to take liberties on your behalf, but also on the IRS's behalf. They, like, for example, they can just say like, well, you know what, we think cost of goods sold should be 75% of gross income, and we're going to reject all the rest. That's that's something that they've done. Like, we're like, well, how do you what basis is that on? Well, there is no basis. It's just the way we feel. And it's like, okay, well, if you don't want to take it to tax court, you got to negotiate. But they have the ability to negotiate, which is kind of nice.
Yeah, it's kind of like any courts where you can settle, right? And as long as both parties agree, you can settle and come to a conclusion. I did want to mention that in our last Q&A, we had a question of what does good books and records mean, right? And so that really just means bookkeeping of some sort. So most people use QuickBooks maybe, or some other like bookkeeping software, accounting software. Double entry accounting software is kind of the bare minimum. So if you're not using that, your books and records are already probably iffy. But if you've got, QuickBooks files that are updated frequently, right? And maybe reconciled even, those beautiful things. And they tie to your previous tax returns that were filed. And hopefully even you have supporting documentation other than that, right? Like receipts or bank statements or whatever else it might be. Those are good books and records. So it's just support for whatever numbers you're showing on the tax return. You'd be surprised how many people do not have that, right? How many people don't have sufficient records to support what they actually wrote into the tax return or reported on the tax return. And so, as Justin mentioned, that's just like a non-starter for the IRS. If you can't first show that you can support those baseline numbers, they don't really care what position you took. They're just going to say, we're changing all your numbers, right? Like that is a whole different conversation. If you have good record keeping and can support those numbers, then the conversation does just become, okay, do we agree or disagree with how you apply the tax
Yeah, and again, we have disclosures that we paid an attorney for. They're very professional, and that will protect you a lot of times when you get audited and they maybe try to change how much you owe. They'll apply penalties, and that's a big part of it. But these disclosures will protect you from those penalties. So. So ultimately, you just end up back where you started. It makes sense. And then we have other ways to recapture those deductions. If you say the statute of limitations ran out for you, we can pick those up by capitalizing those or adding them back to basis. So you get benefit. It might be a long-term thing. It won't be an immediate benefit, but like amending for refund. But we can do that and get you those deductions one day in the future. But I would just recommend that you act now one way or another to keep that statute of limitations open for 2020, which is quickly expiring and has expired for some people.
Right, and so,
yeah.
I don't know, I'm trying to think. Well, I was gonna say real quick, if anyone watching this is not sure when they did file their tax return, that's a great thing to go reach out to your accountant and verify what day they filed your tax return, so you know what your deadline is for 2020. And feel free to reach out to us once you have that number, but that's our starting point, is we need that number to know what we can do for you. What other questions? Let's think.
Well, I think there was just let's reiterate, like, what is the argument again? Like, so there was a little bit of like confusion about, like, are we amending because because cannabis may be rescheduled to Schedule 3 and Schedule 1. We're not amending based on that. We don't believe that when the DEA reschedules cannabis from Schedule 1 to Schedule 3, that the IRS will say, okay, that applies for now all previous tax returns. We don't believe that's going to happen. That's very unlikely. So what the argument is the constitutionality of it. And there was three main constitutional arguments that there are people who believe, many people, and professional people, informed people, that believe that, number one, applying the Controlled Substances Act to the state regulated markets is unconstitutional due to the Interstate Commerce Clause. That's number one. That's the biggest argument. Number two is that the IRS should have never been taxing people on anything but income minus expenses, the profit of the business. I know that's one. Number three is that's unconstitutional. Number three is no excessive penalties. The IRS cannot assess excessive penalties on businesses, and 280 is clearly a penalty. So those are all arguments that are out there. We have a different, again, like to reiterate, we have definitely a more conservative Supreme Court justices than we did back in 2005, Gonzalez versus Reich. We had one dissenting Supreme Court justice, Clarence Thomas, who said that he believed, and I don't know if he said it specifically, but the idea is that he believed it was unconstitutional to enforce the CSA on states with legal programs. And that was 2005. And now we have 6 conservative Supreme Court justices that feel the way as he does. So if that were to be retried, they likely would have a different opinion, It's likely that the CSA would be overturned for states with programs. So that is the argument.
In general, conservative Supreme Court justices tend to have a more originalist interpretation of the Constitution versus a more like broad interpretation. So generally, and this isn't always the case, right? We're always speaking generalities, but liberal justices tend to have that broader interpretation.
Federalist interpretation.
Federal regulation, and those broad, because the federal government is only allowed the powers granted to it by the Constitution, the liberal leaning justices tend to have that more broad interpretation to give the federal government more power to enforce various laws, across the states. And then conservative justices tend to have a more originalist, being like, let's actually just read what it says and do what it says. And what the Constitution says is, specifically for the Commerce Clause, it allows interstate regulation, meaning between the states, not within each state, but between the states. And so that's why the idea that this case would be retried is kind of like, okay, maybe it would be the exact same case, but just the facts and circumstances have changed enough. And the justices is just one part of those facts and circumstances. The other parts are all of the, the history over the last 20 years of how the federal government has approached these state legal businesses. But the facts and circumstances have changed so substantially that we think if this same exact case got brought to the Supreme Court right now, they would have a different ruling. And it wouldn't be that they're really overturning anything. They're just ruling differently on this specific case, which would then set a different precedent for how the CSA applies to these state legal businesses, and indirectly then how 280E applies to these businesses.
Exactly. And so and then we'll wrap up here pretty soon, but like as far as timing goes, in terms of when do we think the Supreme Court will eventually have to try one of these cases and decide whether or not the CSA applies? When can we expect that to happen? I don't know.
Who knows?
Years, probably years, and probably after all your statute of limitations have run out for all the years that you've been penalized with 280E. And even if they say, you know what, we were wrong, 280E should never have applied to you. If you don't do anything now, your statute of limitations will have run out, and you will not be able to get your refunds. So that's
right. So it's important to act now, one way or another. One thing we touched on in our previous Q&A too was about how there is a chance, and we're speculating now, so take what we say with a grain of salt, but there is a chance, and we've seen this with kind of the 471C approach we've taken, that the IRS will have an official position that may contradict this position. Maybe that 280E shouldn't apply. So for example, let's say 280E gets rescheduled. Sorry, not 280E. Let's say cannabis gets rescheduled. 280E doesn't apply moving forward. And officially, the position is that retroactively, you cannot go back and amend tax returns because at that time, cannabis was scheduled differently, right? Let's just say that happens. Maybe that the IRS will just take that official position and still allow people to amend and reclaim those deductions and not dispute that amendment. And just kind of let that be a deterrent for the vast majority of businesses. And then there will be some people who kind of go against what they say, and do so in a way where they're protected, right? So disclosures are important. Well-filed,
in an informed, intentional way, yes.
Yes, informed, intentional. And they might just get that benefit, right, for doing that, for being a little more aggressive and taking that approach. And we have seen that with 471C. When 471C, and 471C, if anyone is not familiar, is a tax, in addition to the tax code that was added in 2018 with the Tax Cuts and Jobs Act, that allows a different inventory methodology for small businesses. And it allows you to just report inventory on your tax return in whatever way your books and records report it. So it gives the taxpayer a lot of freedom to do kind of whatever they want with how they report inventory. And inventory ultimately results in cost of goods sold once that inventory is sold. That's how you get to cost of goods sold, which is the deduction you're allowed on your tax return, right? So officially, the IRS came out with regulations, with guidance that says you can't use 471C to deduct an otherwise non-deductible expense. So they didn't specifically call out 280E, but it was really in response to a lot of kind of like chatter that 471C was going to be the cannabis industry's like ability to just skirt 280E completely. And so they released this guidance that said, officially, you're not allowed to do that. If it was otherwise non-deductible under a different section of the code, you can't use 471C to recapture it. We said we don't agree with that position. That's what our firm stance has been officially, and we've done that for many of our clients. Disagreeing with the position requires a very well-prepared tax return, very good books and records, very specific disclosures to protect the taxpayer. But we've been doing that, and we've seen very favorable results. We have not, our position has not been disputed, right? Our position specifically with 471C, Justin, correct me if I'm wrong, but, and we have heard of other tax professionals in the space who have actually had 471C returns be audited and result in like a no change audit, meaning the IRS ultimately agrees with their position. And so, but the important thing is they have never changed that guidance. They never changed that guidance. And we've seen the vast majority of accountants continue to be very conservative and shy away from 471C and say, well, the regulations say don't do it, so we can't do it. And so that could very well be the case with either a rescheduling or this position we're discussing here today, which is more along the lines of the non-applicability of 280E because of the CSA. And so there's something that's just kind of food for thought. Think about that, because we would not put it past the IRS to go ahead and do that just to avoid paying out everybody their refunds. And, you know, they have a budget too, right? So it's costly for them to audit taxpayers, especially if they're expecting a fight. And it's costly, obviously, for them to allow every cannabis business to go back and amend 3 years of tax returns and get all that money back. So that's going to be something they are considering.
Yeah, I think you're absolutely right. I think that's what's going to happen is they're not going to really do anything. They're just going to let the statute of limitations run out. And then eventually it'll be a non-issue and nobody's going to give a shit anymore, you know? But all those people who lost, they either need to step up and take this to tax court, or it's just going to fade away. And only those people who had the gumption will have been able to get any money back. We're already 10 years in and we've lost so much money. Let's see what we can do about it going forward. And then like the final thing that I'd like to tell people is, and I've been saying this for years, is that it's actually not the IRS that's your enemy, it's your accountants. Because the accountants are the one that strap their clients with hundreds of thousands of dollars in tax debt, not the IRS. That so far, it's been the accountant who has been overly conservative, not willing to do what it takes to advocate for their clients, that put that dig a hole for them. So let's wrap up, Jamie.
If you're in this industry, you need an accountant who is also dedicated to the industry and is willing to take a little bit of a risk for you. That's just definitely important.
Jamie, thank you so much.
Yep, thank you, Justin.
All right, I'll talk to you soon.
All right, bye.